Hello and welcome. My name is Thorsten. I'm the founder of Dividend Stocks Cash stock screen to make long-term profit growth visible for you to benefit from growing capital gains and dividends as well. I've seen, or I'm trying to promote this English site. If you don't know, I have two websites which are basically the same, also from the content, but one time the website is in German and the other time it's in English. And this is the German version, and you see there's a difference in color and in the language. And this one is very popular, and most of the people I earn money with and who visit the websites are from Germany, or German speaking at least. And most of the people here, we have about 12,249 members right now. And most of them are using this website and this website. It's it's still a hidden gem, and I'm trying to improve the situation, but as you might think, it takes some time. Okay, I try to improve the situation, and for this reason I was looking at YouTube what's highly requested. I've seen the Dividend Stocks 2019. That's a highly demanded feature. And I'm doing something similar, but if I do something, I try to make a sense of it. And in this way, I thought I also give you the top dividend stocks 2019 if I were American. So don't take it too serious what I'm doing now, but there is some serious attention anyway. I'm making stock picking like if I were the typical American investor, and then I will tell you what I think of this. Okay, so it's half entertainment and half serious. So let's start. Maybe if you don't know right now, I'm German. This may explain my accent and my bad English. I was one time I was in the US for 1 week in Florida, but everything I say is coming from school. That's my school English. I'm really sorry. So if I were American and I wanted to make stock picking, what would I do? So first, if I were American, I would ignore all the rest of the world. So I would say I'm only interested in stocks from the United States, of course. That's already a huge difference, because if I, as a German, I can't ignore stocks from the rest of the world. It's called a home bias. If you heavily invest in German stocks, but ignore, for example, stocks in the United States or other parts of the world, if you are from the United States, then you may rightfully ignore the rest of the world, because there are so many good and promising companies in the United States alone that you don't need to rely on stocks in other countries, and you even don't have a risk of the currency risk. At least not a direct currency risk. So that's nice. So that was the first thing. The second thing, if I'm an American, now we can stay here in the filter area. The next thing would be I would be a big fan of dividend aristocrats, which means that we are filtering for years of dividend increase. We are only interested in years in stocks with at least 25 years of dividend increase. And here you also know, or you also see, that I'm a dividend fan. That's not something related to Americans only. Everybody can be a dividend fan. So I'm a dividend fan here, and I think dividend aristocrats, they are an US construct. They are coming from the United States. They were invented, I think, by S&P, Standard & Poor's. I think it's okay to say we only want dividend aristocrats. And what's next? Next would be to make the decision if we are a dividend income or a dividend growth investor. That's also American constructs, and I like them really much, because in Germany we don't have this distinction, and we are always speaking of dividend stocks and dividend strategy. That's a hot term, and everybody understands something different, because the terminology is not as clear as dividend income and dividend growth. So okay, we are dividend income investor, which means that let's say that we need or we want the dividend stock to pay at least 3% dividend yield or more than 3% dividend yield. So we still have, we now have 21 stocks. Only 21 stocks. Oh, how bad. That's not so bad. I think the philosophy of this screen is a little bit different than the philosophy of other financial websites like Yahoo Finance, or if these financial websites have any philosophy at all, because here we try to find or to include only stocks which are either highly in high demand, there's a high request or a lot of interest in the stocks. That's the first reason. The second reason, which is even more important, at least in my point of view, that's that the stocks are really promising based on long-term profit growth. If you are interested in this, then visit this section, all stocks. There I'll explain the philosophy and a little bit more in detail. And now we have 21 stocks, and because we are an solid American dividend income growth investor, and we are also experienced, we know that we need to pay attention to the payout ratio, because we want our dividends to be secure or safe. So less than 75% payout ratio based on earnings per share, or if it's a REIT, funds from operations. And because we are really experienced dividend investor, we know that the earnings per share is maybe not the best. We should also pay attention on the payout ratio based on free cash flow, though we do this too. And then we still have 7 stocks. And I don't know how much stocks or how many stocks American dividend investors is looking for. But let's stay with this 7 dividend stocks. We could relax our filtering, but we don't do this, because what I want to show, this also works with this 7 stocks, I think. First, let's have a look at the dividend yield, because that's the most important single aspect for dividend income investors, I guess. So we have dividend yield from close to 7% till 3.24% target cooperation. I think that's okay. We have payout ratios which seem to be safe, less than 75%, both related on earnings per share and free cash flow. By the way, we have 2 REITs here. I've seen Tanga and National Retail Properties. These are both retail REITs. We have the industry I've taken from the Narrate. So this organization, the organization of the REITs, of the US REITs. And we have the years of dividend increase. These are all these blue, everything with blue background is dividend related metrics. And this looks all very promising and very good. Then comes here the growth of the dividends. And that's maybe the first sobering thing. We have dividend growth, annual dividend growth within the last 5 years, rather sluggish. We have no double-digit dividend growth. We have here this Tanga and Target Corporation. It's still okay, especially for dividend income. But here we have dividend growth of 5% or even less. And if we look at the future, then we see that the estimated dividend growth even slows down. At least we have high dividend stability. That's a metric calculating if the dividend, if the evolution of the dividends is stable or not. It's a better metric than the years of dividend increase, because the years of dividend increase gets a reset after 1 year of a dividend cut, for example, but the dividend stability takes into account the dividend evolution of the last decades and tells you even if a dividend cut that was there, or if the dividends only remain stable, the dividend stability may still be very high. So overall, we have seen that the dividends are high, they seem to be stable, but the dividend growth overall is rather sluggish. I think that's what a dividend income investor might expect. What's, in my point of view, even more important, that's the green area here, which is related to profitability and especially profit growth and long-term profit growth. Finally, your overall yield is the result of dividends and capital gains. And if capital gains are low or you make even capital losses, then dividend yield may be high, but your overall yield may not be very good. And this is why profit metrics are very important. And here we see that related to earnings, we have a stable positive earning stability only for Target and Tanga. And that's the two stocks with higher dividend growth. That's no coincidence. You can only grow dividends if your earnings are also growing. And then we have here the growth rates, the annual growth rates for the last 5 and 10 years. That's sorry, that's a little bit in disorder here. So, and you see that the earnings growth is sometimes even negative for the last 5 years, which is not a good thing. And the estimated earning growth is even negative for 3 of the 7 stocks, which is not a good thing either. We can also very important, sometimes even more important than the reported earnings, is the real cash flow. It's the operating cash flow here. And here we see that we have also AT&T with a high operating cash flow, contrary to the earnings, or with a high stable operating cash flow, contrary to the earnings. Although the cash flow in the last 5 years was not very high, the cash flow growth with 1.6%. Overall, I'd say that if we take a look at Old Republic, for example, which has very bad metrics regarding profit growth, then also look what this means. We see it here in the charts. We have the charts reaching back to the last millennium, even longer if I turn off the zoom. And we see this here, then we see that the stock was a nice growth stock in the last millennium, but it's changed starting in 2006. Let's zoom in again. And here we have no growth at all in the last 2 decades. And that's a problem. Why is it a problem? It's a problem because it means that you can't expect capital gains. Take a look at the relationship between the profitability and the losses which were posted here and the capital gains or the stock price. We have a kind of W here. It's the same W as described by the earnings. And here we have exactly the opposite. If you take a look at the dividend yield, because the price went down, the dividend yield went up, then reported earnings came back again. They posted a little profit here in 2010. The stock price recovered a little bit, then they posted losses again, then the stock price dropped again and the dividend yield rose again. So these are the relationships which are always valid for any stock investor, regardless of dividend income or dividend growth. And what we see here is that the stock price in 2005 was still higher than it is today. So not a lot of capital gains if you weren't lucky enough to invest in 2012, for example. So that's what I mean with that you need to take a look at the profitability or at the profit-related metric from profit growth. If we look at Target, for example, we see that the earning stability and cash flow stability is both time positive and both time very high. The maximum is 1.0 and we have 0.96 2 times. And although the growth rates are not extremely high, especially related to operating cash flow of the last years, then it's still we still see that we have growth, we have overall growth, and this means that the capital gains, take a look at just them, that you were able to make capital gains or achieve capital gains with this stock. And although the stock price increased, we see that the dividend yield also increased because the dividend increase was rather high compared to some other stocks we've seen there. What's interesting then is, of course, always the valuation if you have a stock like this, but that's already another subject. Here we see that the stock is based on the last reported earnings in 2019, that the stock is absolutely fairly valued right now based on cash flow and reported earnings. And that's valuation or fair value based matrix here and our matrix, but this is part of another subject. What I wanted to show you is that the typical investor, and that's not only the American investor, but it happens in Germany and other parts of the world too, they are too much focused on dividend related metrics, and they use dividend related metrics they know, like the free cash flow and the dividend increase. That's the dividend aristocrats, maybe still the dividend growth, but they don't pay as much attention on profit related metrics as they should, in my point of view. And then they get stocks like these in their portfolio, which have a really sluggish profit growth. You can also see that here in the on my rank using my ranking. That's my personal ranking, which is based on profit growth. If you're a dividend income investor, then you probably use another ranking like this, dividend income, and then you see that the score improves, but that we still have differences between, for example, Old Republic and Chevron Company, because even in this ranking, at least the growth of the operating cash flow is taken into account. To conclude, pay attention to the profit-related metrics. Even if you're a dividend income investor, prefer stocks with stable earnings and cash flow growth. Don't put your focus only here on dividend-related metrics, even if they include some profitability and earnings like the payout ratios, because these are static ratios. They only show you the current situation, but they don't show you the evolution within a longer period. This is Thorsten from Dividend Stocks Cash. Thanks for watching. Bye bye.